Do you ever feel like your mortgage is that one friend who always borrows money but never pays it back? Yeah, we've all been there. Mortgages can feel like this never-ending cycle where the bank is constantly winning. So if you're looking to pay it off early and stop giving the bank the upper hand, stick around. I've got 10 killer hacks to help you pay off your mortgage faster than you ever thought possible. And you won't need to win the lottery or marry a rich person to do it. Though, if that's an option, I won't stop you. The first hack is very obvious. Hit the subscribe button like it's your mortgage payment. Trust me, it's way easier to crush that button than your actual loan. And the best part is it's free and you only need to hit it once, unlike your mortgage which comes back every single month. Now, moving on, the actual hack number 1, bi-weekly payments. This is one of those simple changes that makes a massive difference over time, but most people don't even know about it. Instead of making your standard monthly payments 12 times a year, you break that payment into bi-weekly installments. So you're paying half of your mortgage amount every 2 weeks. Now, I know what you're thinking. Great, more frequent payments, but what's the difference? Here's where the magic happens. By the end of the year, you have essentially made an extra payment without even feeling the pain. Let's say you have a mortgage of $500,000 at 6% interest for 30 years. Under the typical monthly payment system, you'll pay a total of $580,000 just in interest. Ouch. But with bi-weekly payments, you'll reduce that interest down to $460,000 and knock off 63 months. That's 5 years and 3 months earlier. Imagine being mortgage-free that sooner. Over 5 more years to live stress-free and maybe even retire early. It's like tricking your mortgage into thinking you're paying the same amount, but really you're sneaking an extra payment every year. And it's legal, I promise. Now, if you can't do bi-weekly payments because it might be very frequent for a lot of people, here comes the hack number 2, extra payments every month. We all know that every little bit counts, but when it comes to your mortgage, every extra payment you make can have a huge impact on the total interest you pay. Now, I get it, mortgages are already expensive and you might be thinking, extra payments? Where am I supposed to get that money? From a magical tree in my backyard? But hear me out. You don't have to make a huge lump sum payment. You can do it in smaller bit-sized chunks. If you make just one additional full payment each year, that extra cash directly reduces your loan principal. So if your mortgage is $3,000 a month and one extra payment of $3,000 each year will knock off 5 years from your loan term, as we saw in the previous example. Now, if dropping $3,000 at once sounds scary, I understand. Just divide that payment by 12, which is $250. Now add this extra cash to your regular monthly payment, and boom, you've effectively made one extra payment by the end of the year, without feeling the financial pinch all at once. And again, by adding just $250 a month to your regular $3,000 mortgage payment, you can shave off 65 months of your loan and save about $122,000 in interest. And hey, I'm not telling you to give up your little luxuries. Just sneak in that extra cash like you're hiding veggies in a smoothie. You'll barely notice it, but your mortgage surely will. Number 3, one-time payments. You know that feeling when you get a bonus from work or a tax refund lands in your account and you think this is free money? Well, here's a newsflash. It's not, but it is extra money you weren't counting on. So instead of blowing it on a latest phone, upgrading your car, or a weekend trip, consider throwing it at your mortgage. Every single dollar you throw at that loan counts because you're reducing the principal, and therefore the amount of interest you'll have to pay over the life of the loan will also reduce. Let's say you get $5,000 in bonuses, tax refunds, and other windfalls each year. If you put that towards your mortgage annually, you could shave off 8 years and save around $182,000 in interest. Yep. That's almost a whole decade of life mortgage-free, and that's almost a decade of not freaking about your monthly payment. It's like winning the lottery, except it's your money that you're actually putting to good use. And it's a guaranteed lottery win as long as you buy the ticket, which in this case is putting that one-time payment to your mortgage. Number 4, put at least 20% down. Let's rewind to the moment you first bought your home. If you're like most people, you're probably trying to figure out how little could you put down without totally breaking the bank. But here's the thing, if you manage to save up enough to put down at least 20%, not only will you avoid paying private mortgage interest, but you will also have a smaller loan balance, which means lower monthly payments and significantly less interest over time. If you're buying a $500,000 house and let's say the interest is 6%, a 20% down payment would mean you're borrowing only $400,000 instead. That may not sound like a huge difference, but it is. With reduced mortgage amount, your monthly payment would drop from $3,000 to about $2,400, saving you over $200,000 in interest over 30 years. That's the money that could be going towards vacations, early retirement, or let's be honest, the inevitable home repairs. Now, if you already bought the house with lower down payment, try to get 20% equity as soon as you can. This will help you reduce the insurance payments of anywhere between $200 to $500 every month. Sure, it's hard to scrape that 20%, but think of it like a game of Monopoly where you get to skip paying rent every time, except, in real life. Number 5, increase your income. Alright, time for some tough love. I know what you're thinking. Duh, of course I want to make more money. But seriously, don't wait around for your boss to throw a raise at you. Take control of your earning potential by leveling up your skills, your knowledge, and by earning certifications. The more you increase your market value, the more you can throw at your mortgage, and the faster you can say goodbye to that monthly payment. If you get a raise or a promotion, don't be tempted to increase your spending and reward yourself with more stuff you probably don't need. Instead, put that extra money towards your mortgage. If you're able to put an extra $500 per month towards your loan, that can save you 9 years of payments and $200,000 in interest. And don't worry, I'm not telling you to become a CEO overnight, but hey, every little bit counts, even if it means finally monetizing that weird hobby of yours. Number 6, rent out extra space. If you got a spare room, garage, or even a parking spot, don't let it just sit there collecting dust. Rent it out. Platforms like Airbnb make it super easy to generate some side cash, and you can use that extra income to pay off your mortgage faster. You don't want to deal with the renters? You can even rent out storage space or parking spots if you live in a high demand area. Every extra dollar counts. Let's say you can rent out your spare room for $500 every month. That's an extra $6,000 a year you can throw at your mortgage. Over time, this extra payment will help you pay off your loan way faster and save you boatload in interest. Plus, renting out your space is a great way to meet new people. Just make sure that they're not the kind who will borrow your Wi-Fi password forever. Number 7, prioritize high interest debt. Now, this might sound counterintuitive if you're laser focused on your mortgage, but if you have any high interest debt like credit cards or personal loans, you should definitely pay those off first. Why? Because credit card interest rates are usually through the roof compared to your mortgage. If you don't tackle those debts first, they'll cost you way more in the long run than interest on your mortgage ever will. For example, if you have $10,000 in credit card debt at 20% interest, the longer you let that balance sit, the more it grows. You'll end up paying a lot more in interest than if you focused on paying it off faster and use that extra money towards your mortgage. Trust me, it's hard to pay off your mortgage when your credit card debt is sitting in the corner and laughing at you. Please pay that off first. Number 8, reduce unnecessary expenses. Time to trim the fat. Take a good hard look at your monthly expenses and see what you can cut back on. Are you subscribed to 5 different streaming services but only really use Netflix? It's time to downsize. Cutting back on non-essential expenses might not be the most glamorous hack, but it's one of the most effective ways to free up cash to put towards your mortgage. Here are some ideas. Cancel unused subscriptions, try eating out less and cook more at home. It's healthy and wealthy. Negotiate better rates on your bills like insurance, phone plans, and utilities. By reducing these everyday expenses, you can easily free up a few $100s each month. Then, instead of spending it, put it directly towards your mortgage. Who knew that giving up on that daily $25 Chipotle lunch could save you tens of thousands of dollars in the long run? Don't worry, you can still treat yourself. Just maybe not every day. Number 9, create a budget. I know, budgeting sounds like the least fun thing in the world. But if you're serious about paying off your mortgage early, creating a budget is crucial. Now, budget might not work because maybe you're not disciplined enough to stick to it, but it can at least help you see the real picture of where your money is going. By tracking where your money is going each month, you'll be able to find extra cash that you can put towards your mortgage. This is how you can do it. Start by writing down all your monthly expenses, everything from rent and utilities to food and entertainment. Then see where you can cut back and how much you can realistically afford to put towards your mortgage every month. You might be surprised by how much you're spending on things you don't actually need. If you want to learn more about how to manage your money like the top 1% people, click on the video here or maybe on this side. If you were able to budget an extra $200 each month to put towards your mortgage, that might not sound like a lot, but over the course of a year, that's $2,400. And over the life of your loan, that extra payment could knock off 4 years of your mortgage. I know, budgeting is like the spinach of the personal finance. Nobody wants to do it, but it's good for you. Number 10, don't refinance your loan. Refinancing can seem super tempting when the interest rates drop. The bank might even send you those letters saying, hey, lower your monthly payments, save on interest. It does sound like a win-win, right? But here's the catch, and there's always a catch. Refinancing comes with hidden cost and some long-term downsides. And here are a few reasons why you shouldn't refinance your mortgage. Number 1, refinancing comes with closing costs. Banks don't just refinance your loan out of the goodness of their hearts. They'll charge you closing costs, usually around 2 to 5% of your loan amount. So let's say you've got $300,000 mortgage balance left. You could be looking at $6,000 to $15,000 in fees just to refinance. That's a hefty amount upfront, and it can eat away any potential savings savings from the lower interest rate. Number 2, if you're a few years into your 30-year mortgage, you have likely already paid a huge chunk of your interest upfront. That's how mortgages work. That's how any loan works. The banks collect most of the interest in the early years while your loan balance is still high. So if you refinance, you're resetting the clock and essentially starting all over again with a new loan. You'll end up paying a lot more in interest over the long run, even if your rate is lower. You've paid all that interest and still barely touched your principal balance. You'd be throwing money at the bank for nothing. It's like running a halfway through a marathon and then deciding to start from the beginning just because someone offers you new shoes. Not sure if that's the kind of help you need. You can also click on this playlist to watch the personal finance related videos. It'll make your journey to financial freedom a lot more smoother. In the meantime, I'm gonna go and cancel some subscriptions and see you later.